Hi guys, good afternoon and welcome to the CNBC TV18 Mumbai newsroom. I'm Pavitra Parekh. You're tuned into Mutual Fund Corner, and today we're going to talk all about debt funds, investing in a rising interest rate scenario, who this is really best suited to, as well as the different categories that you can pick within the debt space. So to answer all of these questions, we have a very special guest with us. Harshvardhan Roongta joins us from Roongta Securities, and he's with us here in the studio. So Harshvardhan, thank you very much for coming by and taking up the time to come to our studios as well. Like I told you, it's always better to have these conversations in person. And we have a lot of questions also that have come through. So we'll get to that. But first, on debt funds itself, we always talk about how everyone should have some kind of exposure to debt. But considering that we are in this rising interest rate scenario, do you think there's a case to perhaps pause, wait a bit and then invest later?
So, well, Pavitra, you'll need to understand how debt funds function and what is the relationship of the returns that you generate in debt funds vis-a-vis the movement of interest rate. So, like if you were an investor in fixed deposits, now you've invested a lakh of rupees, you're told that you'll get a 7% interest, irrespective of what the interest rate movements in the economy would be, you continue to get 7% and your principal amount invested is 1 lakh. Now, in a debt mutual fund, it does not exactly work like that. So while you've invested probably a lakh of rupees and you've started with 7%, for example, and if interest rates move, if they start going up, you start experiencing a capital loss on your 1 lakh as well. Okay, and the vice versa. If interest rates are falling, you'll probably make a capital gains on your on the principal amount invested. Now I'll explain, because interest rates and the price of bonds are inversely related. Now I'll explain this with an example. Now suppose that Mr. X had invested a lakh of rupees in 10-year G-Secs, okay, the government securities, 10 years, and the coupon rate was 7%. Now, and the face value is 100. Okay. Now, the interest rate in the economy has moved to 740, 7.4%. Now, most certainly, if I were to sell these bonds in the market, I'm not going to be able to sell it at 100 rupees because the interest rates are at 7.4%. I will have to sell my bonds at a discount. So, if I sell it for, say, 97.5, then the yield to maturity to the buyer is 7.4%. So, if the interest rates are going up, you will find the prices of bonds coming down. So, there's a capital loss. And vice versa, as I said, if interest rates are going down, you'll start making capital gains. Your question is, should you pause at this juncture? While if you look at this in conjunction with the inflation data, okay, we've seen the Jan CPI being at 6.52. Most certainly, it's fair to assume that RBI may go continue the rate hike. So quite possible we may not be at the peak of the rate cycle yet. So in case you invest now and interest rates go up, then there is certainly a case where you might experience some kind of loss. So maybe, there could be some kind of a case in study here to say that there could be a moment where you could experience some kind of interim loss onto your principal amount.
So say there's a new investor who's trying to get into the market, wants some amount of debt exposure, wants some amount of equity. Would you say do the equity part now and wait on debt and look at that maybe in a couple of months' time, reassess?
Okay, so there are two elements to this. You'll have to figure out as to which category do you fit in. So if there is an investor who understands that, the nuances of debt funds, as I explained to you, that if you're investing now and if interest rates go up, there's a possibility of capital loss. And that could be interim, right? I mean, it's not going to be permanent, because when interest rate starts coming down,
you'll of course correct.
You'll correct yourself, you'll make that, you'll recover your losses, the notional loss. However, if there are investors who do not understand the nuances of debt funds, like how do they function, interest rate movement, etc., then I think fixed deposits is a good place to be. And fixed deposits at this juncture, where your SBI kind of banks are offering you 7% plus, I think it's a good rate to go in. If you're a fixed deposit investor, you might as well lock in now or lock in your capital at this juncture. What becomes a point in contention is that if you're going to invest into a debt fund right now, and if there is an interest rate hike again, in the interim, mark to market, you will experience some kind of a loss, which if you're okay to hold on to. I'd like to add further, saying that historically we've seen that when interest rates are in 758 range, the 7.5 to 8% range, if any investor has gotten at this juncture, over a period of 2 to 3 years, they've made very good returns. Why? Because interest rates are kind of peak at these times. You may not be able to capture or to book at the peak. I mean, like how in equity markets, you can't catch the bottom and the peak. So is the case with interest rates. But I think it's a fairly good time to invest with the view that it might, in the short term, give you a subdued kind of a returns. But over a period of 2 to 3 years, you'll recover a good rate of return.
That's very useful, and I'm glad you took us through those examples as well, because like you said, it's important to understand how debt funds work in the first place to be able to get in and to make an informed choice. But Harshvardhan, take us through what you see as the key benefits of a debt fund. Like we tell every investor that please have some amount of debt exposure as well in your portfolio. Of course, depending on your risk appetite, that can change. But what do you see as the key benefits? And then also take us through, whether there's a low risk, medium risk or high risk kind of, portfolio. What is the debt to equity split that you would suggest here?
Yeah, so the first element was that should a person have debt allocation? Because we spoke about this at several locations, saying that you need to have an asset allocation plan in place, wherein some portion of your money goes into equity, some in debt, right? So why do you invest in debt in the first place? So you invest in debt because you want to protect your capital. Like equity is for growth. You want money to grow, and you're willing to take certain amount of risk. In debt, your primary objective is to protect your capital and have liquidity so that, whenever you need the money, you can redeem. And the third point would be get nominal returns. You don't want it to just lie around and get nothing. So this is your objective to invest in debt funds. Now, what kind of investors should get into this? What are the advantages, particularly if I may say so? Of course, liquidity stands first. In comparison to fixed deposits, you can withdraw out or into your liquid funds or debt funds very conveniently. The second element is a tax advantage that you get. Like a fixed deposit, all the interest that you earn is going to be taxed at your marginal tax rate. Whatever is your tax slab, you're going to pay. So you could be even as high as 30%. In a debt fund, for high income earners, I mean, if you're investing for more than 3 years, so that's long-term capital gains, the taxation is 20% after getting indexation benefits. The net effect of tax really comes down, drastically, and your impact would be probably, on a rough basis, if I may say, would be about 10% or so. So there's a huge tax arbitrage. Now, your second question was, is there different categories? Yes. So SEBI has defined the categories of mutual funds. In the debt side, there are 16 categories that you can invest into. So somebody who doesn't want to take any risk at all, it could be no duration risk, nothing. So you have an overnight fund. Okay, that's the starting point of a debt fund, which is the lowest, say volatile or a fluctuating product. Going up to long-term bonds, I mean, you have constant maturity. So there are 16 such categories. You have an overnight liquid, ultra-short money market, low duration. You have short-term, medium-term corporate bond, banking PSU, credit risk. There are a lot of these categories.
There's a product for everybody out there.
Absolutely.
But Harshvardhan, what I actually want to know is that, say I have a medium risk profile, how much money should I put in debt and how much in equity? I'm not talking about the specific debt instrument here or which kind of fund, just overall in debt, how much should I keep and how much should I keep in equity? If you can take us through someone who has a low risk profile, a medium as well as a high risk. I mean, so obviously the debt equity split will also vary, right?
So, Pavitra, the asset allocation ratios that you're talking about is largely dependent on what are the goals and timelines.
Yeah, of course.
So if a person needed money after 1 year, then of course it's going to be 100% debt. So if I remove those elements out and talk in general, so if I remove the specifics to individual like a goal, time horizon, etc.
Let's say a large time horizon or longer time horizon for
So let's take a general, generic view. If a person wants to, with a low risk profile. So low risk profile would entails having a low equity exposure.
Right.
Now, low equity exposure, by all means, if you have a long-term time horizon and you have low risk profile, I would still say you need to have about 50% into equities.
Right.
For a simple reason, because you need to beat inflation. And the only product investment that could beat inflation is equity. So 50% in that case. Now, of course, I'm being generic in my reply.
Of course.
So 50% would be for somebody who has a low risk profile. So 50% debt, 50% equity. A person who has a medium risk kind of a profile, then of course you'll want to increase your equity. So that goes to about 70%, right? If there's a high risk profile, you could go up to 80 to 90%. Now this is again very generic, as I said, but emphasis is on the fact that based on your risk profile, you're deciding how much should go into equity and debt. The reason you're doing this is because over a long period of time, eventually you need to beat inflation on a total corpus. So you need to have equity and debt allocation. Debt gives you that, as I said, capital protection, it gives you liquidity, it gives you nominal returns. So that will be the objective.
All right, that is very useful, and I think that's a complete explainer on how you should really go about thinking about, debt funds and where you should invest. Like you pointed out, there are 16 categories, subcategories within the debt space, so there's definitely something for everyone. You just have to find what fits you best. But on that note, we do have to get into a short break. Harsh, I request you to please stay on because we have lots more queries, and we've actually got lots of queries from our viewers as well, so we're going to take them up after the short break. Hey guys, welcome back. You're still tuned into Mutual Fund Corner here on CNBC TV18, and we still have Harshvardhan Roongta with us in the studios. And actually, we've got a lot of viewer queries which have come in, so we're going to get straight to those and help you understand how you should really go about your investments. The first one comes in from Shailesh Singh, who writes to us from Ahmedabad. He started investing in the Axis Focus 25 fund in 2018. He says, however, in 2022, since the performance of the fund lagged the benchmark for more than a year, he stopped his SIPs, but he left the invested amount in the fund itself. Harshvardhan, he's now asking you, what should he do? Should he withdraw this amount which he left invested, or, should he let it be in the fund?
So Pavitra, if you look at the performance of Axis Focus 25 in isolation, yes, it has not done well. I mean, there is no doubt on that part that it has been an underperformer to its benchmark, which is Nifty 500. Now, the mandate of a focused fund is to create a concentrated portfolio of about, say, 25 kind of companies. That's why it is Axis 25. Yeah. And so ideally, it should not be compared to a Nifty 500. You cannot compare it because it's a 500 stock, portfolio. I mean, the index with a 25 or a 22 stock portfolio. So it's not ideally comparable. Nevertheless, even if you look at its long-term returns in comparison to its peers, like what the category average has been, they've done reasonably well. They may not be the top performer even then, but they're decent enough. I mean, I wouldn't say that there's something very alarming for you at this juncture to look to exit out of it. So considering the fund house, considering that he has been investing for some time, I think he can still hold on for another 1 year and then probably do a review after that.
Okay. So I hope that helps. You can sort of leave your investment in the fund for another 1 year and then take a call. We have another query which has come in. This is from CS Darshan Shah, who writes to us again from Ahmedabad. He wishes to start an SIP of 7,500 to 10,000. This is for the next 20 years that he wants to do this. Currently, he's been investing 2,000 rupees each in the ICICI Prudential Equity and Debt Fund and the Kotak FlexiCap Fund Direct for a period of 5 years. He wants to know a suitable fund to start his next SIP. So he already has some investments. He's looking to invest around 7,500 to 10,000. What is the next fund that you would suggest?
So since he already has a FlexiCap and he has a hybrid equity, which is the ICICI equity debt, I think the value-oriented fund and a mid-cap fund will be the best suited for his portfolio. So he will complement and he'll get the best of the value-oriented investing style and the mid-cap. So what I recommend to him would be to split the investment. So either he wants to do a 7,500 or 10, whatever is the amount, split them into equal parts and invest into SBI Contra Fund and the ABSL Nifty Mid-Cap 150 Index Fund.
Okay, got that. So that will help him, get, like you said, you can put half of it in a value fund and then also look at the mid-cap space. Harshvardhan, while we're on this topic, how many, companies or funds do you think it's good to have in your portfolio? Because there's also the, topic that we talk about very often of over-diversification or putting your money in too many funds because you're not being able to shortlist. Do you have like a broad number that you could suggest?
We always say this, that a portfolio consisting of about 5 to 6 schemes it's good enough. Anything more than that is not serving the purpose of diversification.
You can cover everything in
absolutely,
that.
Absolutely, because each scheme invests into about 30 to 40 companies. And invariably you'll find overlapping amongst them. So 5 to 6 schemes is good enough.
Okay, perfect. So that will definitely help our viewers. The next query is from Joshua Pinto, who writes to us from Mumbai. He says he's keen on investing via a lump sum investment and he would like to be recommended some options on the best performing equity as well as debt funds. He's saying he's a moderate risk kind of investor and he wants to know also about the tax saving benefits that he can get under Section 80cc and which funds would be best suited for that purpose. So equity and debt, what would you recommend?
Okay, so he did mention about the core portfolio strategy and a satellite strategy. So core would be, essentially just for the benefit of the viewers, core strategy would be forming that part of your portfolio which is, say, quality, for example, looking at stability, consistency, etc. And the satellite portion will be where you're looking to get a little bit of extra return in return of some extra volatility that you're willing to take. So the strategy for core portfolio, I'm not still touching upon 80C benefits. I'm just saying if you're building a core portfolio, you would have a Nifty as a large cap and a value oriented kind of a scheme would fall into the core portfolio strategy. You would have an ABSL Nifty 50 equal weight index fund. So that's a large cap index fund and ICICI value discovery. So on the value investing oriented side. The satellite, of course, a mid and a small cap. So you have a Kotak emerging equity and SBI small cap. In terms of the debt, he's asked also because, debt, again, I said there are 16 categories that you can invest into. Without knowing exactly when he's going to enter, what is his time horizon of holding the debt investment, I think a short-term debt fund would be the best category to invest into.
Okay. All right, that sums it all up in terms of what you can look at for equity funds as well as debt funds. Harshvardhan, the next question is about something that we were just talking about actually. So I think you might want to take that as well. Dinesh Jain writes to us from Madhya Pradesh. He has invested 25,000 monthly in a total of 23 funds. This is what we were talking about. So I will ask you your thoughts on that as well. But his current portfolio valuation stands at 7,50,000 and he targets around 10 crores. This is for his retirement in the next 20 years from now. He needs help to filter his portfolio and to have a maximum of 5 to 6 funds. So he really wants to bring it down from these 23. But you know, this happens, it's understandable, right? That you don't understand where to put your money. So you think maybe let me spread it out. But if you can, help him here.
Yeah, so the good part on this, Pavitra, is that Dinesh knows that he needs to do this.
Yeah.
I mean, we have to sometimes educate people that there's no point of having 23 schemes for a 25,000 rupees per month.
Right.
So yeah, rightly, you could just have 5 schemes. So I can suggest 5 names. 4 of these I've picked up from your existing portfolio. So there's not much that you will have to do. Just have to consolidate bit. Now 5,000 each in the following schemes: HDFC Index Sensex Fund, Parag Parikh Flexi Cap, ABSL Nifty Mid Cap 150 Index Fund, SBI Small Cap, Motilal Oswal Nasdaq 100 FOF. In this, amongst these 5 schemes, I've only added one Mid Cap Index Fund, which is new. Otherwise, all 4 are your existing schemes. And of course, if you want to consolidate, Dinesh, you will have to liquidate out of the other schemes that you have other than these 5 and reinvest them back in the same proportion into all these 5 schemes. With regards to accumulating 10 crores after 20 years with this investment, well, it will not be possible just with this investment that you're doing, which is 7.5 lakhs of accumulated corpus and 25,000 SIP. You'll have to increase your SIP to about 90,000 rupees in case you wish to accumulate 10 crores after 20 years. You may not be able to do that right away, but slowly and gradually, you know how much you need to get to. So as and when your income goes up, please make sure you keep increasing your SIPs.
Okay, that's very useful. And Harshvardhan was pointing out as well, you may not be able to do this right now, but as the years go by, you can look at going on increasing your SIPs. And I think, that's a lesson that all of us can probably take, right?
In fact, as a thumb rule or as a matter of practice, not a thumb rule, as a matter of practice, we suggest that your investment should increase in the same proportion as your income goes up. So if you're looking at a 10% increment, your investments should also go up by 10%, because this 10% increment every year will just suddenly balloon into a big amount when you look at, after 10, 20, 30 years from now.
Yeah. Oh, absolutely. I think that's very useful advice for everybody to take, not just for this query, but I'm going to try to squeeze in one final query on the show as well. Vimal writes to us from New Delhi. He has been investing 1,000 rupees in the HSBC Value Fund for the last 8 years. He wants to know whether he should remain invested in this, whether he should exit, if there's a better option. What would you suggest?
So, well, again, most certainly the HSBC Value Fund has not been performing, or rather, I would not say it's outperforming its peers or benchmarks. So it has been an underperformer, no doubt. But if I look at the data again for 5 to 10 year period, then it is in line with the category average.
Yeah.
So I'm assuming that this is just a phase that this fund is going through. And since he's already been investing since 8 years, I think he can continue for now and give the fund manager some more time and the benefit of doubt that this is just a cycle.
Yeah.
He's having a bad patch probably, and they will get back. So I think, Vimal, you can hold on to this scheme, continue investing, look at it more closely for about a year or two, and then again, probably you'll have to review it.
Okay, so continue to hold on to the HSBC Value Fund for now. Harshvardhan, on that note, we're going to wind down on this show, but thank you very much for coming by, taking us through a complete explainer on debt funds and also answering all of these viewer queries. Thank you for joining us. And with that, we will wind down on this edition of Mutual Fund Corner. You guys stay tuned because closing bell comes up next for the final hour of trade.